Okay. Hi guys. Today we're going to be talking about MT4. Just a second. Okay. So let's start with what we're going to be talking about today. Today is going to be a guide into MT4. Here at Equiti, we use MT4 and MT5. MT4 stands for MetaTrader 4, which is a popular electronic trading platform used by online retail forex traders and institutional as well. It was developed by MetaCode software and was released in 2005. Now, there's a lot of advantages into MT4. We're going to be talking today about how to use it and the different types of order types and execution, the key terminologies, and how to manage profit and loss. Okay. So just want to make sure that my voice is clear. 1 second. Okay, so back to this. The key advantages of the MetaTrader trading system is that it's very user-friendly and it is one of the most used trading systems in the world. MT4 allows traders to access global financial markets and trade various financial instruments, including currencies, commodities, stocks, indices, amongst other products that we do offer here in Equiti, offering a wide range of tools for technical analysis, such as charting and indicators, and also supports automated trading through expert advisors, but that comes for a later stage, which are just software programs that execute trades based on specific trading strategies. So it provides you with everything that traders need in global financial markets for direct execution and orders, while allowing risk and profit control with accuracy in most cases. Now, MetaCode is basically the mother of Meta4 and Meta5. And now I'm going to be direct with positions. But just to be clear that the MT4 is basically a trading platform that a lot of brokers use as a way to give you access to a variety of trading into the global financial markets, to a wide array of products that we do offer. And there are several advantages for this. And one of the most one is a user-friendly interface. MT4 is designed that to be easy to navigate. The platform is intuitive and can be customized to suit the needs of individual traders. Now, also has advanced charting capabilities, and later on, when you move through being an intermediate, or let's say a beginner to intermediate and advanced, you'll be able to use these charting capabilities that enable traders to conduct technical analysis and identify trading opportunities, while using a range of indicators and tools to help you customize your trading experience and also help you be a profitable trader. Now, of course, it is a secure platform that has advanced encryption techniques to protect client data and ensure security of trading transactions. And it's also big on community, because most of the brokers here in the UAE and globally use MT4 for use. Okay, so now let's move on to the types of positions, and then later on go on with the contract sizes. So here we have the base currency and the quote currency. In order for you guys to be very clear about how to take a position on MT4, you need to understand the basis of a base currency and a quote currency. Now, Euro USD, one of the most traded FX currencies in our industry, and that's why we'll be using it throughout this presentation as an example. Assets in global financial markets consist of two parts, the base and the value. For the Euro USD, if a trader expects the price of the pair to rise from 120 to 125, and then that means that you expect the euro to rise against the dollar to fall against the euro simultaneously. In any case, the price will be targeted to rise, in which case you would preferably go through a buy order, also known as long, as I've mentioned before, in the different key terminologies that we use in the FX or financial markets field. Now, a buy position long is taking a long position, meaning buy the base currency and selling the quote currency simultaneously. So when you're buying the euro, but you're also selling the USD. So the position is taken when the trader expects the price of the asset to rise. That is, the base currency will become of higher value than the corresponding currency. Sell position short. A sell position is known as short selling, and again, it's two positions taken simultaneously, but here the purchase is executed on the quote currency, which is this, and the sell is made on the base currency. Thus, it's a position taken when the trader expects the price of the asset to fall, the quote currency to become of higher value than the base currency. So for the USD to actually go up in value and the euro to devaluate, let's say, which means that we expect that the euro is going to fall, in which case you take a sell position, i.e. short position. Now, there are different contract sizes. The most popular one is a standard lot, which is 100,000 units, let's say, of the Euro USD. And the mini lot is 10,000 units of the base currency, known as 0.1, and the micro lot, which is equal to 1,000 units of the currency. The main difference between contract sizes is the amount of the underlying asset that is being traded, because all different assets have different units of value. Contract sizes may vary depending on the financial instrument being traded and the specific contract specifications of the broker. Therefore, it's very important for you guys to understand the kinds of lots that you're taking, also depending on the amount of capital, the initial capital that you have in your account. So let's say if my account is small compared to others, or just small, let's say, I cannot afford to take let's say 5 standard lots. Like, it will not make sense for my capital. If the market goes against me, my account's going to be liquidated. Therefore, it's really important that you do assess the risk reward ratio. Is this gonna liquidate my account? I don't want that to happen. Therefore, I'm going to be very strict with me applying my standard lots or my mini lots, let's say. In a later example, this will all be clear to you. And another example that I want to say is that, for example, in FX field or in the foreign exchange market, a standard lot is typically 100,000 units of the base currency, meaning if a trader buys one standard lot of Euro USD, they are buying 100,000 euros. A mini lot is usually 10,000 units of the base currency. So that means that if you're buying with a mini lot, you are buying 10,000 units of the base currency, and so on. So in general, there's different sizes or different contract sizes, depends on the asset that you want to use. Let's take a futures market example. Contract sizes may vary depending on the commodity that is being traded. For example, a contract for crude oil futures may be 1,000 barrels of oil, while a contract for gold futures may be 100 troy ounces of gold. Therefore, although it's really easy to put a sell by market or a buy my market in order if you anticipate the prices going up or down, and it's super simple to actually execute the order, it is important that you know how much units of value that you're actually risking here, or that you're buying, or that you're selling, just because it's important at the end to your initial capital balance. Now, in general, larger contract sizes obviously require a larger margin and involve more risk, but can also potentially lead to greater profits. And that's why we do have some feisty traders that trade with large volumes, and sometimes they do have the amount of capital to actually risk it all. So it depends. If you're a new trader, it's better off to start small. Now, the change in the value of one currency relative to another is measured in pips, I've previously said in my first webinar, which is the fourth decimal place of the number that we're seeing on the screen, the value of one unit of currency also. So to take advantage of this small change of value, you need to trade large volumes of currency to see any significant profit or loss, because you can't just trade knowing that it's going to change 10 pips. That's like a really small profit that you would make. Therefore, let's speak dollars. Like if you think it's going to go from 116 to 117, then okay, you can take a more, or let's say a higher standard lot or a higher micro lot. Now, one thing that I do want to mention here before I move on to the next slide, this is a mobile kind of phone screen chart, and here we have the stop loss. And if I haven't mentioned this previously, stop loss is something where you can limit the loss that you have in a given transaction or in a given position. Let's say you are speculating that the price of the EURUSD is going to go from 116 to 117. So in order to stop your loss, then you're going to go put stop loss at 115.90. So in case the market actually goes against you, or let's say you don't want to be, like markets are actually really volatile and they're fluctuating really heavily, you can't put your stop loss, let's say 114, because it can go back to 115 and then jump again to 117. So stop losses are equivalently important. They do fluctuate. So if prices fluctuate in front of you, you can amend your take profit and stop losses. Take profit is where you want to actually take your profit. So let's say you are speculating that 116 is going to jump to 117, you put your take profit to 117. If you think that the price is going to go 117 20, you put it at 117.20 if you're that exact. So I just wanted to quickly explain to you guys what's the difference between take profit and stop loss. Also, as how user-friendly this is, when you actually press plus or minus, a number will come out and you can just minimize, or like, let's say, increase it or minimize it in terms of where you want to go. So I will not like put for you 114. I will not put like a number that doesn't actually exist on your screen. I will take you there where you want to go. And also it will be more of an assist, but you just have to adjust the key numbers over here. Now, like I said, each product that we have has a different kind of contract size. So let's take this example. In terms of currencies, if you're buying a currency, it's 100,000 units for standard lot and 10,000 for a mini lot, $1 approximately. And a micro lot is 0.1 approximately, which again is a number of pips. For gold prices, it's in ounces. We measure the value of unit in ounces. So 100 ounces for a standard lot, which is $10. You're buying 10. And for a mini lot, it's 10 ounces, which is $1, 10,000 mini lots, and also 1,000 micro lots for gold. Probably the same thing for silver, but here in silver, we don't move in 100s, we move in 5,000. So a standard lot for silver is actually 5,000. And it moves in pips, which is $50. And 500 for the mini lot and 50 for the micro lot. For oil, we also use for a standard as 1,000 barrels, and a mini lot is 100 barrels, and a micro lot is 10 barrels. Of course, when you're buying a position on oil prices, you're not going to be like, I'm going to buy 20 barrels. No, you're going to choose your micro lot, in which case you can calculate that after. So it's much easier. I'm just showing you kind of a deeper glance into what is just shown to you on the chart, so that you know how professional traders actually do calculate their contract sizes, and how much do they vary, and how much difference does it make into taking these decisions. Okay, moving on, about the importance of lot sizes. So it should be noted that it's simple to buy contract values in whichever the trader wants, as long as the deposit amount is sufficient to cover the margin. In other words, make sure the initial capital that you have in your account is sufficient enough to cover your losses. But also, this is just for risk management. Who knows, you can make double the profit or triple the profit, but also make sure to have sufficient capital to cover the losses that you could be making by taking that much leverage, or by taking that much amount of lots, because by taking this much amount of lots, that means you're buying much and much and more. So instead of buying 100,000 units, if you take 3 lots, that means you're buying 300,000 units. It's a lot. So if your trading account is small, then make sure that your lot sizes is according to that. But if your trading account is really large, then okay, it's acceptable for you to take that much sizes into speculating the prices as well. So moving on to the British pound, let's say you want to buy 3.76 lots on the British pound. It means the following: you bought 3 standard lots, 7 mini lots, and 6 micro lots. So micro lots is the second decimal place. You can take 4, 5, whatever, how many lots you want, but just keep in mind that you need to have sufficient capital to just a minute. Okay, I was receiving comments of the screen not being shared. Anyways, I hope that you guys can see it now. Okay, guys, apologies for the technical glitch. Is my voice clear? Okay, so let's start since my voice is clear. Now let's move on to the types of orders. We have 7 different types of order for pending execution orders, which means that they're not going to take place now unless there's a condition from your side for them to take place. So let's say we want a buy limit. A buy order is used to execute a purchase at a lower price than the current market price, and a sell limit as a sell order is used to execute a sell at a higher price than the current market price. In other words, if you want to buy but you think that the market's going to go lower, you can actually place a position in which case you are buying at the specified price that you want, which is lower. In that case, it's more profitable for you. And the same thing goes for sell limit. If you actually want to sell, you want to have a sell order, but the price right now is too low for you to be selling at this price. You want to wait for a higher price. So then you do a sell limit order. Buy stop is basically a different approach. It's the opposite of limit orders. A buy stop is a buy order that you place if you want to buy at a higher price than the current market price, which is like a sell limit, but you're just buying. And a sell stop is a sell order you want to place if you want to sell below the current market price. Now, take profit order is something that I've previously explained. And again, it is used to set a specific price at which the deal is automatically closed and the profits achieved are sufficient. Stop loss is an order used to determine a specific price at which the position is automatically closed to specify an amount. Like I said, if the market is going against you and you want to buy from 116 to 117 and the market's going against you and you look at yourself and you are at 115, if your stop loss was, let's say, at 115.50, then you would have saved yourself a big loss. You can also put your stop loss at 114 if you think the price fluctuating from 115 to 117, but you want to take advantage of that move. So in order not to limit your options, you can place your order or you can place your stop loss at 114.50. And that way, if the market goes full swing against you, your stop loss was at 114.50, so you didn't lose that much. And it's the same thing for going up. Take profit if you think that the price is going to go from 116 to 117. You want to put your take profit at 117 if you think that the prices are, while you're trading and watching the chart, that you think that there is more bullish momentum in this case, and you think that the prices are going to go further above, you can adjust your take profit into, like, let's say 117.80 or 118 in whichever way that you think this could go. So here in the chart, you can see that we have here a sell limit, a buy limit, a sell stop, and a buy stop. So here you want, like I mentioned, that you want to buy at a specific price that is higher. It's like a sell limit. You want to buy at a higher price. So you put a buy stop at 0.99. And a buy limit is you want to buy as well, but at a specific price that is lower, or let's say it's not the market price that you want. So therefore, we have these 4 options to specifically be customized to the market price that you initially want. So like we said here, a buy stop is a buy order that you place if you want to buy at a higher price. So you are buying here, but the price is here, but you are going to buy here. A sell limit is that you want to sell at a higher price as well. The price is no longer here, but you want this. So you sell limit here, and sell stop is if the price is at a higher price as well. So a sell stop is at, so here it's at a higher price and here it's at a lower price. And that's why they vary from sell stop to sell limit to buy stop. Or you can just buy at the current market price. This depends on the strategy that you're using. It depends on the kind of trader that you are. and that way you can be able to educate yourself more on the types of order there are. And these orders is there to just help you with a wider range of orders to make you have a profitable position. Let's say you are going to sleep tonight and you think that the prices tomorrow are going to go to X. So that's why you create a pending order, an order that, for example, if you looked away from your screen or you fell asleep and the prices hit the jackpot that you want at that market price, then this is where you use these pending execution orders. Now, closing positions. Closing the trade, whether it's too long or short, it means that you are reversing the initial position. Thus, if you are closing a position of buy, you are selling the base currency and buying the quote currency. Buying GBPUSD will consist of buying GBP and selling the US dollar, like we said, buying the base currency and selling the quote currency, and they are carried out simultaneously. So let's figure this out. Why are you buying the GBPUSD? You're buying the GBPUSD because you think that the British pound is going to go up. So you are buying the GBP and you're selling the dollar. And by the way, they work inversely. When you see that the dollar's chart is going upwards, you're going to see that the GBPUSD is going down. Therefore, you are speculating that the GBP is going up. Therefore, you are buying the GBP and selling the dollar. Buying and selling is carried out simultaneously at a specified price. When a trader closes a financial position through close, it means that the system will reverse previous position so that the entry of the closed position is selling the GBP and buying the US dollar. So when you actually close the position, it means that you're back to selling the GBP. That means that the momentum on the GBPUSD right now has become somewhat bearish. If a lot of traders like you close their position on the British pound, it means that the British pound is likely to continue to fall, not rise. If everyone starts buying the GBP US dollar, it's going to drive up a lot of momentum. It's going to take the GBP higher. Usually these sharp highs and sharp lows that we see in financial markets are driven by a lot of analysis, technical analysis and fundamental analysis. For example, the Bank of England recently raised rates by 25 basis points. We saw the GBPUSD right now, it's just going up. So there's a lot of factors to take into place when you are buying and selling on the MT4, but the key importance or the best thing to know here is that if you put a stop loss, you're going to limit your losses. And if you put a take profit, you're going to you're going to be basically conditioning your position to take your profit at this exact amount price. So taking an order, this is a mobile screen kind of show. Here, when you open the screen, you will have the trading instrument, the EURUSD. Here you can see gold if you're trading commodities, oil or stocks, major indices, S&P 500, whatever product here, it will appear for you at the front of the screen. Now you have an automated stop loss order and you have an automated take profit order. However, these are optional. Some people do like to trade without, but to guarantee that or to risk manage your position, definitely should have a stop loss and take profit set so that the market doesn't swing against you. And if that actually happens, you are capable of hedging your position to go or ride the wave with the market. So that's the good part about MT4, that no matter where the market is going, you can take position to reach where the market is heading. Now, like I said, when you're taking a market execution, you also have the option to take market execution, buy limit, sell limit, buy stop, and sell stop. It all depends on the market price that you want to buy or that you want to sell from. Now, these lines over here are basically the price movements during an execution. So let's say I bought the EURUSD right now at 116.997, and then I saw that it's going down. What do I want to do? It's going down. So will I close my position? Will I wait? Will I adjust my take profit? Will I adjust my stop loss? All these things are super possible for you to do. That's why it's really easy to use MT4. You can adjust your positions. But of course, I do recommend using a demo account to kind of take all the orders that you need to see the advantages of taking a buy stop, sell stop, or different kinds of pending orders, to see the different kinds of lot sizes. The demo account starts at $50,000. So with that, you can buy a lot of lots, and you can see the amount of losses that would actually make you drop your account's capital if your trades weren't successful. And if they were successful, you're going to see a lot of green, and you're going to see your account double up. So demo accounts are practically really important, especially if you are a beginner trader, just to kind of see or navigate your way around through MT4 to see how things go. So viewing orders and positions, account details, profit loss here. You're going to have your balance of the initial capital that you've pushed, or you're going to see the it's not just the initial, obviously, it also accumulates the profit and losses that you've taken. So let's say you put 100,000 and you made 9,000 profit. This is why it's 109,000. So it's basically your accumulated profit and loss. And then we have here the positions that you've taken. So here, obviously, the trader is bullish on the USD JPY. He's just buying. And he's making a good amount of profit, 121.61. He's obviously taking use of also the pips. So he's buying at 112.380, and right now the price is at 112.65, which means that he's taking a good amount of a lot size, which is why he's making $121 and just let's say 200 pips up or down. Now, reading price action, the GBPUSD, like I said, again, base and quote currency. The first currency listed on the left is the base, the British pound, while the second currency on the right is called the quote currency USD. Pairs always quoted. Currencies are always priced in pairs, and you can buy one currency and sell another simultaneously at the same time. A pip is a measure of the movement of currency pairs and represents the fourth decimal digit point, the pair's exchange rate. The AUDUSD pair moves from 08950 to 08980, meaning that the price has risen by 30 pips. And again, in this example above, we can see that the price here has moved from 380 to 650. So here he's taking advantage of the number of pips, not the change in dollars. The pip in the USD JPY pair is the only different one, with the pip represents the second decimal instead of the fourth decimal place. So, and it applies to gold, silver, oil, and gas. So here, let's say the USD JPY moved from 115.30 to 115.49, means that the price is moving by 1.9 pips. So we're only assessing the second decimal place. Now, the value of a pip is determined by two basic things: the trade volume, the contract size, which I've spoken a lot about, and the exchange rate of the currency pair. To calculate the value of a pip, divide one pip, usually 0.0001, by the current market capitalization of the Forex pair, and next multiply the number of contract size. The contract is the number of underlying units you trade. Let's take an example. A trader took 3.18 lots on the Euro USD. How much is a pip in this position? The pip price is in direct pairs is $10. So the price of one pip in the position taken by the trader is 3.18 times 10, and it's 31.8 USD per pip. The equation is pip value is the pip decimal number times the contract size, which is $10. So Here is the pip number, and here is the unit value that you want to use. Now, pip value. For indirect currency pairs, the dollar is the base currency, such as the USD CHF. Here we have a different kind of formula. The USD is no longer the base currency. It's no longer the code currency, it's the base currency. Pairs should be reversed to make the dollar the code currency. For example, USD CHF is currently at 0.9100. To reverse the CHF currency pair to USD, you're going to divide the 0.900 by 1, and that's going to give you 1.099. So again, the pip value is the fourth decimal point times the unit of values multiplies by the number that you have been given as the currency if reversed, and that's how you calculate the initial let's say value of units. So you want to calculate the value of units multiplied by the number of pips multiplied by your initial price, and therefore you get basically the full amount of what you're trading, as in 10,000.989. Leverage. How does leverage work? Also known as margin trading. Leverage is when a broker supplies you with money so you can maximize your position beyond your initial capital, and it's usually expressed in proportions, for example, 51 and 101. Like I said, if you have in your account $500, you can trade with up to $50,000 or $100,000. However, you need to ask yourself, what if you make a loss? What is going to happen to your account then? Therefore, your all other profitable trades can be liquidated just by one loss. Therefore, it's very important to calculate the pip and the unit of value calculation that I've just done, and not to exceed in terms of the leverage that you are willing to accept on your account being liquidated. Let's say you make $50 a trade. If you use 101 leverage, it multiplies your trade 100 times, means that 50 times 100 is 5,000. So that means you have actually tripled your amount of profit into $5,000. Your trade is now worth 5,000 instead of 50. And any profits that you make will be greater by the same ratio of 101. If your trade was unsuccessful, your loss will also be 101 greater. So instead of having 50, you're going to be minus 5,000, and that's what you don't want to reach to. Therefore, if your account balance was, let's say, 50,000, you can bear a loss of 5,000. But if your account value was at $2,000 and you made 5,000, then you lost them, then no, your account can't bear that much of leverage. So slow down. Margin. If you open a short or long position, the broker holds a portion of your account equal to the contract value divided by leverage. This is called user funds or required margin. It's basically a portion of your account which is equals to the contract values divided by the leverage. So it's everything accumulated and calculated with your leverage and your contract sizes. For example, if your account has $10,000 and you want to buy 5 lots of GBPUSD at 125, the contract value is leverage is 1,500. It's always expressed as in a column, and one contract is 100,000 for the GBPUSD. So 5 lots equals 5 times 100,000 is 500,000. So here you are buying a 500,000 lot size position, and therefore it's huge. So 5 lots is 500,000 units of value for the GBPUSD. Can your account handle that? That's what you need to assess your risk management process. And if yes, then wonderful, because you just made an exquisite amount of profit. So another example for profit and loss calculation is, example, a trader decided to buy 3 lots of GBPUSD, starting the position at 127 and closing the position at 114. Okay, so here the 3 contracts means 300,000 value of units, like explained, one value of unit for one standard lot for a currency pair is 100,000. Therefore, 3 contracts means 300,000. Pip value is 10. Spread is closing price minus opening price. So 114 minus 112 is 21 pips. And the formula is number of pips, 21. And the pip value, which is 10. And the position size, which is 3 lots. And the profit would be made as 6,300. That's, of course, if your trade goes into the way that you want it to go, hopefully. So it's just a minor and simple formula that you kind of need to understand. The price is, the spread is the little difference between the closing and the opening price, or between the bid and the ask price. And that's why the formula is so simple. You just need to know the most important thing in this formula is 3. It's the number of lot sizes that you take, which is equivalent to 300,000. So 3 is not 3, it's 300,000, and it depends on each asset that you've taken into account. And that's why you need to be cautious, and you need to understand the position size that you are taking and how many lots does that mean, and is your capital at the end of the day sufficient enough for this profitable trade or not. Anyways, guys, that was your introduction into MT4. Please do let me know if you do have any questions. Thank you for watching us, and we do have another series of webinars coming, including introduction into other than global financial markets, introduction into how to use MT4 indicators, how to use technical analysis, how to use fundamental analysis, how to use smart reports. So we're going to take you through all this round, and we are always here happy to help you with experiencing a better kind of trade. See you guys next time.